We just don't know about the U.S. elections, about inflation, and goodness knows about cryptocurrencies. This is Bloomberg Wall Street Week. I'm David Weston. This week, special contributor Larry Summers of Harvard on the good, the bad, and the ugly of U.S. elections.
I'm quite encouraged. The center is holding.
And Glenn Hubbard of Columbia on a Republican plan for building an economy for sustainable growth. An awful lot happened this week, but it's not yet clear what it all meant. The U.S. held those much-anticipated midterm elections, and instead of a big red wave, we got what amounted to a little red ripple.
The red wave didn't happen, and instead we're going to have more divided government.
With the full consequences still up in the air.
How do you get things done with a Republican House and evenly divided Senate and Biden as president?
We also got consumer price numbers for the United States. They were good, coming in lower than expected on both the headline and the core numbers. But they left us wondering whether this was the beginning of inflation's end or a false dawn.
A significant improvement in the data that wasn't expected by the markets.
And then we come to the wonderful land of cryptocurrencies. The so-called emperor of crypto got dethroned. Sam Bankman-Fried had to turn over the keys to his FTX kingdom to his arch-rival, Xiao Jinping, only to have him promptly give them back. And then, as the week ended, the other shoe dropped. SBF resigned as CEO as FTX filed for Chapter 11 bankruptcy, leaving questions about the broader crypto industry.
One of the people that are kind of larger speakers in this industry had said that we were looking for contagion in the industry. This is the contagion.
But if the rest of us had some doubts this week, the markets sure didn't share those doubts. The markets took one look at those CPI numbers and never looked back. With the S&P 500 up 5.9% on the week, its best week since June, the NASDAQ up a whopping 8.1%, and bonds very much in demand with the yield on the 10-year falling 35 basis points over the course of the week. Here to take us through what they saw in this dramatic market turn are Lori Calvasina. She's head of U.S. equity strategy for RBC Capital Markets, and David Bianco. He's chief investment officer at DWS. So welcome back, both of you. Good to have you here. David, let me start with you. What did you make of this week? It was such a dramatic turnaround on Thursday. Should we believe it?
I would not. I would take it with a grain of salt. What a week it was, the midterm elections and the inflation report. And let's not forget Veterans Day. Without our vets, a big thanks to them, there wouldn't be peace. The inflation report stole the limelight, though, for the week. And arguably, I don't think it should have. It's just one data point. And while it's very welcome that inflation's come down from the highs, it still seems broad-based. And particularly broad-based in services, which suggests the labor market is still extremely tight. I'd argue that we see narrow disinflation at goods, apparel, used cars, and still broad-based service inflation. So I think inflation is still a risk. And I just remind people that in October 2021, inflation was about 6% back then. And so it's still about over 6% on a core basis now. That's a lot of inflation over the past 2 years.
Laura, it's a really good point. I mean, we like to focus on how much it's come down. It has come down some finally, but it's still at a very high level. And do we have any assurance it's going to keep coming down at a fairly brisk level to get us down to 2% or thereabout?
Well, look, I think it's all about where the numbers come in versus expectations. And if you look at street consensus, they're already baking in pretty significant moderation, kind of heading back to 3% next year. So I think it was, not surprising to me to see such a fierce reaction in markets. Maybe not, I didn't expect quite as much as what we got. But I can tell you, David, I've talked to a lot of investors the last few weeks who have really, kind of quietly arguing it was getting ready to come down, building their models, and, had gotten fooled by this, several times in the past when it didn't happen. And I think there was just tremendous relief that this kind of idea that inflation is moderating, that we finally got the data to cooperate.
It's moderating for one data point, Lori,
yeah.
But we've had the chair of the Fed say again and again and again, I need more than one data point.
Yeah.
I need quite a few data points before I'm really going to believe it. So do we think this is actually going to change Fed behavior at this point?
Well, unfortunately, I think that the Fed probably didn't like the reaction that we saw on Thursday, and I wouldn't be surprised to see the rhetoric, take another, kind of hawkish tone to try to clamp down enthusiasm. I think things are going to stay choppy for quite some time. Let's enjoy the day while it lasts. It was a nice week. We've been in need of a nice week in the equity market, but I wouldn't, necessarily expect this to go up in a straight line from here.
David, I wonder, are the markets basically baking in, really getting back down, if not to 2%, to sort of 2.5%, 3%? Are they a little complacent, particularly bond markets?
I think the markets are complacent. It's interesting how the bond market also yields fell upon the inflation report, and maybe that's all that equities need to know. But yes, investors expect inflation to come down, but at this stage, we can't keep saying eventually. It's important that the Fed or other factors get inflation down quickly, because we're looking on the verge of inflation becoming a multi-year problem. And if high inflation is a multi-year problem, that might change the entire inflation risk premium demanded by the bond market. So I think we're very lucky that the bond market is staying calm about inflation so far, and we shouldn't press our luck.
So clearly the CPI drove the markets this week. They drowned out any news about the midterms. Was that right, David? Did we pay enough attention, do you think, the markets to the midterms?
Well, Lori and I were talking. It seemed like investors were trying to follow some game plan they had in mind about how the market would rally post-midterm elections. A Republican red wave didn't happen. Hopefully the inflation report wasn't a surprise negatively. It was positively. But I think this has gone too far too fast. And I think they did put too much emphasis on the inflation report, trying to ignore the midterm elections, which are still uncertain.
Still uncertain, but it looks pretty divided. It's not clear that Congress is going to do an awful lot. Is that good news for investors, bad news?
I think it's good news from the perspective of historically a divided government. When you have a Democratic president and a split Republican Congress, you're getting 13 to 14% average type returns in the S&P 500. So the history is very favorable. I think a lot of investors know that history, and so if nothing else, it gives you a little bit of confidence. I think the other issue is, in terms of gridlock being good, I think the last thing investors want right now is more stimulative policy. So I think there is good news in that. And look, I think this was a win for the markets. This was a win for democracy this week. We don't know the results yet, but things did go pretty smoothly.
Lori's right about the historical data, and we've talked about that, but I think investors are putting just too much weight on that historical observation, and I'm not sure a divided government is all that wonderful right this moment. There's likely to be fiscal fights ahead. Let's see what happens during the lame duck session. Even if Democrats hold on to the Senate, they might want to use the lame duck session to push through some more policies. And I just think the poor showing amongst the Republican Party at a time of such high inflation is not good for the supply side. And the weakness on the supply side is part of the structural problems we're seeing with inflation.
Larry, everybody right now wants to draw parallels in history. It depends on which history you pick. But I know you've done work specifically about 2002, I believe.
Yeah, it's eerie, David. I mean, we've actually seen there's about a 78% correlation between how the S&P 500 is trading this year and how it traded back in 2002. And there are some similarities. That was another midterm year. There was a geopolitical angst in the backdrop from 9/11 and the sort of build-up into the Iraq War, similar to what we've got in Russia-Ukraine these days. And it was also a period of messy normalization after we'd had a big crisis, big drop in the market, initial rebound, and it took basically a year and a half for the market to get back on its feet, find a bottom, and I think we're doing something similar right now.
Not only 2002, 2018 was a year where after the midterm election, Fed policy and Powell taking a pretty hawkish stance at the December meeting of 2018, saying several more hikes are likely. Market fell almost 20% in December 2018. That was a midterm election year.
What about geopolitics? Lori mentioned that briefly. I mean, we still have a war going on in Ukraine. We've got President Xi meeting with President Biden next week. Unclear what's going to happen there in Asia. There are geopolitical issues here. How much is the market discounting those?
The market is aware of it, trying to ignore it. There are certain industries where the tension's growing, like in semiconductors. But it does seem like, and even with this election, that tough on China and support of Ukraine, too, I think that's the policies and sentiment that will continue to prevail.
I want to come back to something David talked about, which is President Biden said democracy is on the ballot. Former President Obama said that as well. It looks like whatever happens here, most Americans they sort of believe in the election process. They showed up, they voted. Not a lot of disputes yet, really, about what happened. How good is that for the markets? Because to some extent, the markets depend upon, a regularity of our processes.
I think stability is good. I think, the fact that the democratic process worked pretty cleanly, there weren't a lot of fights. It was kind of a boring midterm at the end of the day, other than having, polling data kind of make a lot of people disappointed in the end. And I think that's good ultimately for the investability of the U.S. when you're thinking about global investors and the premium they're going to give U.S. assets, particularly in the equity market. You need that political stability.
How big a wild card is the debt ceiling, David?
They'll lift it.
You're confident of that?
They always have. But sometimes they put us through some headaches before it's done. But it is important to acknowledge that with these interest rates, these climbing real interest rates, a little bit of a reprieve on this week, Thursday, Friday, but there's risk, especially if that inflation risk premium goes higher, that the debt and deficits will be more burdensome. Look what's already happened. Housing's getting crowded out. People are getting a lot more demanding on the valuations for innovative businesses and stocks. We're crowding out innovation. We're certainly crowding out housing.
I wonder, Lori, a lot of talk about a possible recession next year at some point. Not clear how long, how deep, even whether it happens, but a lot of people think it's quite possible. Do we have the optionality from a fiscal point of view to deal with a recession right now, given what's going on with interest rates, given how much we've borrowed, and given deadlock up in Congress?
I don't know that we have a lot that we can do at this point in time. I think that, I think that's one of the reasons why investors are so focused on the equity side at getting the Fed to pull back while there is still time to push us into something deeper. And I think that's one of the big takeaways from this week is that even if you sort of believe the last round of hawkish Fed rhetoric, did that CPI print, at least for now, put us on a path where we can look for the Fed to take their foot off the pedal sometime early next year and avoid having this be a late 2023 recession, more of just kind of an early economic hit. I think for me, that was one of the biggest takeaways on the CPI.
Lori Calvasina and David Bianco will be staying with us as we turn from what happened this week to how to invest around it next week and the week after, for that matter. That's next on Wall Street Week on Bloomberg.
In reality, a disillusioned American electorate quite plainly, sternly reassessed the empty promises of 1992 and concluded unmistakably that the incumbent administration not only had presented itself in false economic colors as something new rather than an all too familiar throwback to the 1960s, but had been seriously off base and way out of touch with the changing times. Bill Clinton has been campaigning from the start against the 1980s. This week, the 80s won.
That, of course, was Louis Rukeyser on Wall Street Week back in 1994, when a different president's first midterm election ended in a repudiation of his economic program. And the #1 movie in America was Interview with the Vampire, while the #1 song was I'll Make Love to You by Boyz II Men. What a difference 38 years makes. Some people expected a similar rejection of President Biden's economic plans, but they didn't get it, as the two parties fought to essentially a draw. And the Democrats are on a path to losing fewer midterm seats than any party in power in 20 years. Still with us are David Bianco of DWS and Lori Calvasina of RBC. So let me come back to you, Lori, for a second. Let's talk about how you invest around what we're seeing right now. Given what's going on in the CPI, given some of the uncertainties about inflation, and for that matter, geopolitics, how do you make investment decisions in this climate?
So I think you still have to stick with the longer term trajectory, kind of where you see the most opportunities longer term. I think that there is still a real case to be made for switching from the kind of new economy back to the old economy. Areas like industrials, energy, financials, a lot of these areas still have very, very good valuations. I think on the more growthy side of the market, I think you want to be more selective. So we obviously saw things like communication services. A lot of the tech companies really rallied pretty fiercely over the last couple days. I think you still want to be careful there. So we like tech, we like things like software, we like things like semis, which look pretty washed out on earnings sentiment, but we'd be a little bit more cautious with some of the internet-related names.
But to draw a football analogy, that sounds like running off tackle 3 yards instead of throwing a long ball, that you're not really betting on a lot of big growth in the near term.
I think so. I think so. And you know, what we see when we look at different economic forecasts is the price we're likely to pay for a short, shallow recession is subpar economic growth that follows. So think of something like 0.5%, 1%. That is an environment in which valuation will matter.
So David, what do you think of that? I mean, is this a time to really dial it back some? What are you interested in as an investment opportunity?
Well, toward the latter parts of this week, we've gotten more defensively positioned. I do think that we have a small recession next year, and I do believe it hits profits. Profits would be flat at best, probably down 5%. I think Lori's down a little bit more than that in her estimate. So the S&P's at 18, 19 times forward earnings. And, you know, even though it's just, in our view, a short and shallow recession ahead, I think there's going to be more frequent recessions than we've been accustomed to in the past 20, 30 years during the 2020s. And also inflation a little bit more sticky. I love these clips. The 1994, after that midterm election, I mean, that's when Clinton pivoted. And it's also when the Republicans had strong messaging and policy suggestions and a long period of economic growth and declining inflation for that decade and 25 years after that. So I'm just not sure we saw the signs of that happening today.
So what stocks do you like, David? What should we be looking?
I focus on industries, and then my portfolio managers pick the stocks and their various strategies. I'm most overweight healthcare, both big biotech and pharmaceuticals and big banks. Then we're dabbling in a few other areas like aerospace and defense and oil services, where we're overweight. But we're also underweight a lot of things that we think are going to be weighed on by the goods and the manufacturing recession that we see ahead. Materials, much of industrials. We're still cautious on semiconductors. And everything consumer discretionary, auto, retailing of both brick and mortar, and even internet retailing.
Lori, how does that match up with you? For example, semiconductors. Do you have a different view on semiconductors?
So I think with semiconductors, what we're seeing is that basically nobody's taking earnings estimates up right now. And historically, when nobody's taking earnings revisions up or earnings estimates up, it's usually pretty good 12-month forward signal in the market. Now, it doesn't mean they're going to turn around today. We have seen some of the price action improve there a bit lately, but it's really a longer-term kind of contrarian type call. I would say, though, I think Dave and I are mostly on the same page on a lot of stuff. You know, we like the banks. I think we both still like small caps at this point in time. And, you know, I'm probably, a little more cautious on the defensive areas of the market. I think things like staples and utilities still very expensive. You've had some room left in healthcare valuations, but that's starting to creep up as well. So you're
not as enthusiastic about healthcare as maybe David is.
I'm still overweight, but I'm getting a little concerned about it. I mean, frankly, just because coming into this reporting season, we were getting close to peak valuation on that sector as well, and now we've knocked it down a peg or two. That there were some rough earnings with this sector, but I think we have to tread cautiously on the defensives. I like small caps, I like banks because they are typically areas that do well coming out of a recession. You've got really cheap valuations. In the case of small caps, we've got a bucket of work showing that they're pricing in a recession already. In financials, I think it's more of an earnings resiliency thesis, more of a domestic play. But I think it's probably time, in my estimation, to start looking for some of those recovery trades.
To what extent have the projections of earnings taken into account inflation? Because that really is a margin pressure issue, isn't it?
Well, so what our modeling has shown on inflation, that if you sort of think about how they play into an earnings model, for example, I see positive correlations with revenues. So the inflationary backdrop has really been goosing revenues in S&P 500 companies. We find that when inflation comes down, it doesn't really help margins all that much, but bringing inflation down is going to pull revenues down. Wages are actually, kind of the more important factor within margins. So one of the reasons why we've been so cautious on earnings next year as a whole is because we are baking in that moderation in inflation. It's going to pull the revenues down. It's not going to help the margins as much. But I do think a lot of people who cover stocks don't understand the revenue dynamic and don't appreciate that the impact on margins isn't going to be as big as they think.
Where are you on earnings going forward? What are you projecting?
My estimate for next year is 220, and I expect this year to finish up at about 223, 224, thanks to energy. So
you're down, but just a little bit.
Down slightly. The average recession, but we're expecting smaller than average, causes a 15 to 20% decline in profits. But usually more than half of that decline in profits is from financials and energy. Energy is smaller than it's been in the past, although it's growing every day. And we think banks will be fine because we're not expecting credit costs to surge.
Well, aren't banks really benefiting from increased rates?
They are. They are.
Simply?
And it's been one of the bigger areas that we've seen in terms of upward revisions. And so when you think about why the earnings estimates haven't collapsed as much as we might have otherwise expected at the broader level, it's financials, it's also energy. Until recently, you've actually seen net positive revisions in energy.
Are you concerned at all, David, about possible cracks in the system overall? We've seen some, certainly saw it in the UK with the pension plans.
Sure.
And there's some rumblings back in the United States. Are you worried about that?
Well, I can't say that I've been able to point out a systemic risk that's, really keeping me up at night. Frankly, I'm more concerned about geopolitical issues.
FTX is not a systemic risk?
I don't think so. No.
What do you make of that?
I make it out of just too much speculation. And I don't think it's systemic, but I do think it is something that has stung and will continue to sting many people involved with that. Now's not a great time to be speculative, and the dollar, at least from for Americans, the dollar is doing just fine, and I wouldn't be too enthusiastic about finding alternatives right now.
Have you been interested in cryptocurrency at all, Lori?
I try to avoid it at all costs, but
Why?
Well, look, I think that I think David and I both lived through a lot of these cycles, and it just. I'll tell you what I sensed this time around, very different from the dot-com bubble, but there was a lot of skepticism in our community about crypto. I find that you had sort of certain pockets of the hedge fund community that were true believers, but I think most of the people that I talked to have been pretty skeptical, didn't really understand necessarily what the point of it was, kind of solving a problem that didn't exist. And I think, I've always sort of believed when you don't understand it, you want to avoid it.
Sounds like Warren Buffett, actually. He used to say that, as I recall. Thank you so much to Lori Calvasina and David Bianco. Coming up, we're going to take a look at next week on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. It's time now to look ahead to next week on Global Wall Street, starting with Juliet Sally in Singapore.
Thanks, David. India will kick off a busy week in Asia with its October CPI report Monday. Bloomberg Economics expects inflation to slow sharply, which should allow the RBI to reduce the size of its next rate hike. Japan's third quarter GDP on Tuesday will probably show an abrupt slowdown in growth on surging import costs. China's October activity data, according to Bloomberg Economics, likely to reflect damage to production and consumption from the COVID curbs to contain a spate of outbreaks. And Australia's jobs report will probably show an increase in the unemployment rate.
Global climate talks in Sharm el-Sheikh continue into their second and final week. But in the UK, the economy will very much be in focus. On Wednesday, BOE Governor Andrew Bailey will deliver his quarterly monetary policy report. That comes ahead of the government's big autumn statement on Thursday. Chancellor Jeremy Hunt will set out his tax and spending plans as the UK looks to fill its fiscal black hole. And on Sunday, another eagerly awaited event, the pandemic-delayed World Cup, kicks off literally in Qatar.
Following last week's surprise moderation in consumer prices, the week ahead includes producer price data for October, where prices paid by companies remain above 8%, but still well below the near 12% rate logged back in March. Additional economic data include building permits, housing starts, and existing home sales. And the earnings season enters its final stretch with a slew of reports from retailers, including Home Depot, Walmart, Target, TJX, and Macy's. And finally, the SEC deadline arrives for money managers to disclose their stock positions from the third quarter. The flurry of 13F filings should give some interesting insight into how they were positioned heading into that midsummer rally and the sell-off that we had in September. David?
Thanks to Juliet Sally, Danny Berger, and Romaine Bostic. Coming up, the United States is getting a new Congress. However, the votes ultimately add up, with an opportunity to rethink a policy for sustainable growth. We're going to talk with former chairman of the Council of Economic Advisors, Glenn Hubbard of Columbia, about what a sensible Republican plan might look like. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. The U.S. midterm elections may not be fully resolved yet, but President Biden didn't wait to talk about whether they point to a rethink of his policies.
What in the next 2 years do you intend to do differently to change people's opinion of the direction of the country, particularly as you contemplate a run for president in 2024?
Nothing, because they're just finding out what we're doing. The more they know about what we're doing, the more support there is.
To give us his views of where economic policy might be headed, welcome now Glenn Hubbard. He's Dean Emeritus at the Columbia Business School, and he was the chair of President George W. Bush's Council of Economic Advisors. He's also author of The Wall and the Bridge, Fear and Opportunity in Disruption's Wake. So, Dean Hubbard, thank you so much for being back with us.
My pleasure.
Really wanted to talk to you because there is this question, where do we go from here? I mean, we don't yet know exactly what happened with the midterms. We've got a pretty good hunch. Probably a narrow majority for the Republicans in the House. Quite possibly the Democrats will hold a 50-50 sort of split in the Senate. What should Republicans do? If you're up on Capitol Hill, is there a sustainable economic policy for growth they could pursue?
I think there is, and in fact, there's a pivot for the president too. You know, listening to him just now reminds one of the aphorism of learning nothing and forgetting nothing. It's time for a pivot. And I think for Republicans, GOP is instructive: growth, opportunity, and participation. There's a way to develop bridges to take people, take communities, take more people to the economy that will be in the future. We've done this before in the country. We can do it again. And it doesn't have a partisan label. Anybody could grab it, but it's especially apt for the GOP.
So let's talk about walls and bridges, which you wrote about in your book. It strikes me, and maybe I'm not being careful enough in listening to it, I hear a lot more about walls and bridges, I think, these days. A lot more about protecting against change, perhaps both on the Democrats and the Republicans, than about how do we embrace change and get ready for it.
You do. I mean, if you start with the growth part, change is important. There is no model or theory of growth that doesn't involve change. So we need change. The question is, how do you bring everybody along? And that's what we hadn't been doing so well in the past few decades. Populism embraces that, and we need to address it. And so to do that, you really have to help individuals with training and education. You have to help communities to bring people along.
Can we afford to do it? Because
sure.
We don't have zero interest rates anymore.
Oh, sure. In the book, I outline everything from community college block grants to aid to communities to reform of the earned income tax credit to support work. All of that is probably about $100 billion a year. That's real money. But compared to what we've been doing, compared to student loan relief alone that was $400 billion at a stroke of a pen, we can afford to do this.
You mentioned earned income tax credit. A lot of people think that that's a good reform that could be pursued. What about the child tax credit? Because that's something the Democrats badly want. They wanted to put through. Republicans don't like it so much. Is that a constructive thing to allow people to re-enter the workforce in a positive way?
I think it could be, and it's part of what could be a compromise package. You know, if you want to allow more people to come back to work, you have to loosen all constraints on work. And I think the child tax credit could play a very powerful role there if it's accompanied by rewarding work, which is what the earned income tax credit could do very well.
Well, what about that point specifically? As I understand it, at least, one of the issues for Republicans is if you're going to give these breaks, you should actually sort of require work. It should be conditioned upon getting to work rather than just giving people the money. Is that right?
It should be, but that's a feature, not a bug, in the sense that participation in the economy brings dignity, it brings honor, and it brings support for the economic system. So that ought to be one of our goals. The question is really supporting work and making work pay. The EITC, or an income tax credit, among other things, can do that.
So, as I understand from you economists, there are two ways to grow. One is more people working, and the other is more productivity. Ideally, you get both of those. Talking about more people working, some of them are living in the United States right now. What about immigration? Is there a way to really address immigration, which has really divided the parties? It's a problem we have to address at some point in a way that would actually give us more people constructively in the workforce.
It's super important. Immigration has always been one of America's great strengths. And the immigration story is really two parts in policy. One is about very high-skilled immigration. And there should be no doubt. We should want every scientist, doctor, business person, entrepreneur in the world who wants to be here should be here. The political debate over low-skilled immigration is harder. But rather than saying no to low-skilled immigration, how about yes to training support and helping more people come along? I think that would ease the political dilemma.
Have we ever done that training support well? And by the way, should it be private sector or public sector or a combination of both?
The truth is we have. So if you think back to the 19th century, the whole land-grant college movement, which I build on for community colleges, is exactly that. The GI Bill with President Franklin Roosevelt after the Second World War. We have done this. And yes, it should have heavy involvement of the private sector. Throughout the country, we've got great partnerships of business people with community colleges, with communities, because they know where the jobs are. One size fits all from Washington, less efficient.
Other issues like productivity, there are ways to address that.
Yes.
And by the way, go back to the Trump tax cuts. Was that an effective way to deal with productivity by giving certain tax credits for investment? Did it work?
Well, I think it did. Unfortunately, trade policy went the other way and created uncertainty and diminished investment. But yes, a pro-investment tax policy is a big deal. But it's not the only thing. For example, we need to be spending much more on basic research in the country so that we keep our lead and our competitive advantage in new science and new technologies. And I think we could profitably put applied research centers around the country, again, drawing on the land-grant college model, to help local businesses in local areas compete better.
Did the CHIPS Act, which I think I folded into the Inflation Reduction Act, I get confused on the names sometimes, was that a good step in that direction, basically, to because I think there was a fair amount of money toward basic research, wasn't there?
The basic research parts, yes. I worry that parts of the act look a little more like corporate welfare for me. What I would prefer to see is much more on the front end for research and then allow businesses to figure it out, which they will do.
One of the fundamental walls, as it were, to use your term from your book, has been trade policy, protectionism, some would say. There was a time when I think, sort of simply stated, Democrats tend to be more protectionist. They want to protect workers, including unionized workers. Republicans were more free trade. I'm not sure that's true anymore.
It's not, and it's a problem. Whether you're a Democrat or Republican, trade is very good for the economy. Globalization gets the political rap. In fact, technological change has been far bigger than globalization in disrupting the workforce. But we need to address it. We need to help people cope with whether it's the China shock or other trade disruptions in the economy. Otherwise, we shouldn't be surprised when politicians say no to trade.
Right now, most people, I think they're observing are thinking we're going to have stasis up on Capitol Hill. It's going to be split. Nothing's going to get done. If it was possible to do something, what would it be? I mean, let's put you in charge and say you come up with your bill, one bill that you think would make a real difference. What would it be?
Well, I think you have to ask yourself, what problem are you trying to solve? So if the idea is to bring more people along, greater opportunity, greater participation, I think it would be saying no to the student loan forgiveness and starting over with something like a big block grant for community colleges. Those are the foot soldiers of training people for the economy that will be, whether it's younger people or people who need retraining. I think massive support for work. Again, possibly combined with a child tax credit. These are things that, frankly, some years ago, both Paul Ryan, when he was chairman of the Ways and Means Committee, and Barack Obama, when he was president of the United States, both agreed.
Is progressive taxation a wall or a bridge? Because, again, oversimplifying, I think Republicans tend to say, let's cut taxes, including, and maybe especially for the more wealthy. Democrats say, let's raise taxes on the wealthier. Does it make a difference? Does that help address some of the underlying causes of populism?
Well, I think we will need some revenue given the nation's fiscal problems, and progressivity is important in the tax system. That said, if you want growth and opportunity and participation, you do need a tax system that's consistent with that. I think the failure to adapt to change is what's led to populism and tax policy that has not been that welcome in the business community.
I won't necessarily ask you to name names, but are there people who have this vision who are active in politics today? You mentioned, for example, Paul Ryan. He's not in the game anymore. Are there people that are sort of listening to you and people like you?
I think there are many governors and senators who have ideas like this and have long had ideas like this. After all, everything that I'm talking about once was in the center of both the Democratic Party and the Republican Party. Ronald Reagan, when he reassembled a coalition, effectively did that on growth and opportunity and participation.
Fascinating. Great to have you with us. This wall and bridge is a really powerful way of thinking about it. Many thanks to Glenn Hubbard of the Columbia Business School. Coming up, we're going to wrap up the week with our special Wall Street Week contributor, Larry Summers of Harvard. That's next on Wall Street Week here on Bloomberg. This is Wall Street Week. I'm David Weston. We're delighted to have our very special contributor, Larry Summers of Harvard, back with us now on Wall Street Week. So, Larry, it was a big week on a lot of fronts. Let's start with the CPI numbers that came out. They certainly got the market's attention. What did you make of those CPI numbers? Are they as encouraging as some people seem to think?
I think they were good. They were good numbers, but one number is never decisive, and there were a lot of special factors in these numbers, some of which will be reversed. Particular, as always, Team Transitory only focuses on the things that are likely to come down in the future, not the things that are likely to go up in the future. I don't think apparel prices will keep going down so fast. I don't think we've really got structural disinflation in medical care. But this was a good number, and the market was right to respond positively. Whether the magnitude of the reaction was right, I think that's very much in question. There was another number yesterday, which was the Atlanta Fed number on wages, and that was showing continued strong wage inflation. And I don't see a way, as long as inflation is running in the 5-6 range, that we're getting to target. So I think the people who declared victory on the basis of this number yesterday were overreacting. But look, it certainly was an encouraging number. But we had similar encouraging numbers in March and similar encouraging numbers in July. And one swallow didn't make a spring then. And so I think we've got to do what Jay Powell has said he's going to do, which is be vigilant and integrate all the data looking forward.
And that was my question, actually. We know how the markets reacted. The question is, how will the Fed react? We have a little time till that December meeting. At the same time, given what you've seen so far, it can change. Do you think that the Fed should be varying its path 1 iota? Some people are now saying instead of 75, it should be 50, for example, in December.
Well, I think the market's been expecting 50 for some time as the most likely case, and I don't see a reason to change from that expectation. I don't think you can make judgments based on a single month's data. There was a very substantial adjustment in markets' expectations of what the Fed would do, and I wonder whether that a change quite that large of more than one full move, one full 25 basis point move, was warranted on the basis of just this number. But it may well prove to be appropriate given what we see in the future.
Larry, how much more difficult are the markets making the Fed's job? Because the financial conditions loosened dramatically in response to those CPI numbers, the most since March of 2020 when they announced $2 trillion in fiscal stimulus. You
have to look at both the Fed funds rate and at the overall level of financial conditions. To some extent, I think these financial conditions indices are misleading, because when the stock market goes up, they call that an improvement in financial conditions, but it may just be a change towards more optimism about the economy. So I'm not that taken with the financial conditions indices like the ones that come out of Goldman Sachs that give significant weight to the stock market or to credit spreads in the overall assessment, because I think in some sense they're not just reflecting what the Fed does, they're reflecting changing views about the economy.
Larry, arguably the other big news this week were the midterm elections, which, by the way, aren't really fully finalized yet because we don't know the results, including who controls the House and the Senate. But at this point in the process, what do you make of these midterms? So one thing I learned was, once again, that people don't pay that much attention to the pollsters or, by the way, the media.
David, look, I'm quite encouraged. The center is holding. If you look at people on the extreme of either party, they actually underperformed quite badly. There was more ticket splitting as people voted for one Democrat and one Republican, rejecting the more radical candidates. The swing towards Democrats came from independents and came from more Republicans voting Democratic. I think the reaction to the radical Supreme Court decision was actually a substantial part of this story. That's probably cautionary for Democrats, because it's not always going to be that way. But look, we're not having people in the streets fighting over the results of elections. Candidates who lose, even very radical candidates who lose, are conceding. I think this was an election that suggested some movement back towards the center of the country holding.
What message do you think the White House should take away from this, particularly with respect to economic policy? Is this time for a mid-course correction? Are there some lessons in here for the White House? And by the way, should they even take a look at who's on the economic team? Is it time to revamp that?
I think they've got very good people. I don't think the people are the issue. It's a very experienced team. Inevitably, over time, administrations have turnover. Look, I think the country is governed best when it's governed from the center and governed with moderation. Nobody's going back to $3.5 trillion new deals. It's not on the table, and I think it's appropriate, given inflation, that nothing like that be on the table. I think there's a lot we can do to bring down the price of energy by promoting energy production of all kinds, renewable and non-renewable. I think there's a lot that the administration can do and will do with respect to technology, particularly in the semiconductor area. It's a big challenge to actually build infrastructure out well in a way that's going to contribute to reducing bottlenecks in our economy. I would like to see more partnership between business and government. And frankly, if we're going to build out the necessary energy infrastructure around the world, I don't think there's any alternative. So I think that the administration has a real opportunity now to move to an implementation phase.
Larry, one other big development, globally at least this week, was the next climate summit in COP27 over in Sharm el-Sheikh. Are we making progress on the climate or not? It seems sometimes like they just get together and talk.
Yeah, yes, I agree with that. But David, I think more is happening in the laboratory and less is happening in the conference room. The good news is that tremendous progress is being made in all sorts of technologies that point towards renewable energy. There are some really exciting developments with respect to batteries and storage that enables renewables because it's not always windy or sunny. So I think, ironically, even though there's less political progress than one would have hoped, I actually think we're in a better place with respect to the problem than one might have expected a decade ago because of the progress in technology.
And finally, Larry, I can't leave this week without talking about Sam Bankman-Fried and FTX and that meltdown in the crypto exchange. Apart from the details of what exactly happened, what does it tell us about the need for regulation, and why don't we have regulation? We've been talking about it forever, Democrats and Republicans. How pressing is that need? How can we get it done?
You know, David, a lot of people have compared this to Lehman. I would compare it to Enron. The smartest guys in the room, not just financial error, but certainly from the reports, whiffs of fraud, stadium namings very early in a company's history, vast explosion of wealth that nobody quite understands where it comes from. I think the regulatory community ought to draw two lessons from this. One, if we had a few fewer economists and quants and a few more forensic accountants running around, I think it would help us detect what was going on in countries and in companies. The more I watch, the more that field of forensic accounting seems to me important. And the other is, I think we ought to have a rule in everything that touches finance that everyone who has anything to do with it in a position of responsibility has to be entirely away from the office, away from their phone, away from any device and connection to the system for a week or two continuously each year. And I suspect that would be very helpful in causing some of these problems to come to light sooner. But absolutely, but I think this is probably less about the complexities of the nuances of the rules of crypto regulation and more about some very basic financial principles that go back to financial scandals that took place in ancient Rome.
Okay, Larry, that was very helpful. Once again, that is Larry Summers of Harvard, our very special contributor here on Wall Street Week. Coming up, what do the bond market, green energy, and lottery tickets have in common? That's next on Wall Street Week on Bloomberg. Finally, one more thought. Looking for opportunity wherever you can find it. In a time of market downturns,
investors are looking at portfolio losses that remind them of 2008.
And runaway inflation.
What matters is the Fed saying we've got to get inflation back down.
And more than a little political uncertainty.
Of course, we'll have to see the final results of these midterms. We're looking at razor-thin margins right now.
All of us have to be even more resourceful in looking for new opportunities. Former Bank of England Governor Mark Carney wants us to find them in sustainable energy.
A lot of the answer to energy security problems that have been exposed by Russia's illegal war have to do with sustainability.
Citadel CEO Ken Griffin thinks he's found opportunities in moving to Florida.
I'm going to say something that's like, that's going to be thrown out of here. Taxes were not part of our decision to come to Florida. Because when you've got great schools, when you've got a great environment, when your streets are safe and clean, you've got a place where people want to live and call home.
And not surprisingly, the CEO of Delta Airlines has found opportunities in travel.
We're seeing an incredible amount of demand that's continuing. It's been in place for most of this year. We're looking at the upcoming holiday period. It looks very, very strong.
And then there's the irrepressible Simon Cowell, record producer, international television personality, and creator of reality series like The X Factor and America's Got Talent. Cowell can take credit for discovering hit makers like Fifth Harmony and One Direction. Cowell's latest discovery? Well, it is the bond market, where he just raised $125 million selling bonds backed by his Got Talent TV shows.
Right now, I feel like James Bond.
But the all-time winner of the Golden Opportunity Award goes, at least this week, to the holder of the single lottery ticket sold in California that earned for its lucky holder, get this, $2.04 billion. And it wasn't only the winner who got some opportunity. The man who sold the ticket, Joe from Joe's Service Center, is walking away with a cool $1 million as well.
I will share it with the family, with whatever I need it, with my kids, my grandchildren. I have 11 grandchildren.
Now that is what I call opportunity. That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.